Hey everyone, Simon Says Money here. Welcome back to another video. In this video, I will be explaining the surging stocks, which are the recovery stocks mainly, and how you can short the market with some ETFs, but be really cautious with these ETFs because they are 3 times leverage. Before we get on to this video, don't forget to like and subscribe and turn on that bell notification so you don't miss a video of mine. I post content on the stock market, investing, and ways that we can achieve financial freedom in the future. So don't miss out. As a disclaimer, I'm not a financial advisor or CPA. Please use your own investment decision, and this is for entertainment purposes only. Now let's get on to this video. The February 2021 job report blew past expectations thanks to a sharp rebound in leisure and hospitality service hiring, which are considered to be recovery companies or stocks. The Labor Department reported that payrolls rose by 379,000 in February. The unemployment rate edged down to 6.2%. As I presented in my previous video, those recovery stocks have been doing well during the last 3 months. I expect these companies will continue to be doing well for the next 6 months at least. The Nasdaq volatility earlier today was almost down by 3%, and the 10-year US Treasury note yield went up to 1.62%. As I explained in my last video, we want to keep the 10-year US Treasury yield less than 2% for the market to keep going up. Cyclical sectors like energy and financials have been doing well as recovery stocks like the cruise lines, airlines, and travel stocks. The job report is better than expectations, which should be or definitely is good news. But it looks like that the stock market doesn't like it because it would lead to inflation concern, which would lead the Fed to take actions such as potentially stopping QEs, quantitative easing, and increasing the interest rate. In addition, the additional stimulus coming from Congress should be the wind in the sails to get the economy back on track, which would further put the stock market under pressure because of inflation concerns. That's why today in the morning the stock market again was all red. On Thursday, stocks slipped again as Powell fails to reassure investors. Let's watch this short clip.
Bring in Matt Orton. He's of Carolina Tower Advisors, also joined by Leighton Spar, president of SS&C Alps Advisors. Thank you to you both for joining us. Matt, first to you, just this downward movement that we're seeing in stocks today, coming on the heels of the comments that we got from Jay Powell earlier, spooking investors. He's not worried about rising rates. Are you worried about what we're seeing play out in the bond market?
Well, great to be back, Shauna. And the answer is no. I'm not too worried about what we're seeing happening in the markets right now. I've been saying for a while that we've been a little bit extended in the equity markets and they are more vulnerable to these types of pullbacks. And growth does not come without a risk. And I think that's what a lot of investors are starting to learn. But on the flip side of this is that we're seeing some significant drawdowns in stocks that look very, very attractive. So some information technology stocks that have very, very good earnings that have posted incredibly strong Q4 earnings results, strong guidance going forward. I think those look attractive to potentially reload if you've missed them or you're looking to reallocate. But the move up in rates also provides, and I think reinforces the case to be in certain more cyclical areas of the economy that we've liked for some time, such as financials and especially the money center banks that are able to do better with net interest margin and are also benefiting from the activity in financings, IPOs, SPACs, and all of that.
Fed Chair Jerome Powell vowed to keep monetary policy steady on Thursday. He expressed little worry about inflation and provided no indication of policy changes ahead. Bonds and stocks both sold off on the comments. A sell-off in equity still ensued as benchmark 10-year Treasury yields jumped another 7 basis points to 1.55%. What happened? While Powell didn't say anything different, markets focused on what he didn't say. He didn't reassure the market. That's the key. Investors were likely looking for something that was more specific to stabilize the market. Today, I am going to present some recovery stocks, UAL, NCLH, and CCL. First, United Airlines, ticker symbol UAL, currently trading at $50.52. Everyone is familiar with this company. Before the pandemic, the share price was around $86. As we can see, scrolling back all the way here until this sharp fall. Now it's around $50. More importantly, during the last 3 months, the share price increased from $30 to now $50. And with the increase of people taking vaccines, more and more people will be able to travel freely, and the airline companies are definitely the first one to benefit from them. The second company, NCLH, as known as Norwegian Cruise Lines Holding. People have been staying home for 1 year, way too long. Once they can freely travel, they are going to book vacations, especially with the $1,400 check coming from the stimulus package. In addition, the savings of Americans are high now as compared to last year. They are missing vacations, and cruise lines are the stocks benefiting from it. NCLH is one of them. Early last year, its share price was around the $55, high 50 area. Now it's around the $29. And same as United Airlines, during the last 3 months, it increased from around $16 to now $29. And I can see that it will soon reach its last year's level around $55. Another cruise line company, Carnival Corporation, CCL. Very similar chart. Early last year, its share price was around $48. Now at $26, and during the last 3 months, it has increased by about 90%. And I will not be surprised when it's doubled within the next 3 months. As I presented in my previous video, number 38, currently I believe that the Nasdaq is in the wave of A here. I expect that during the next 2 weeks, we will go through the wave B as it did last September and October. I hope that we will have another V chart and Nasdaq will just go up without pulling back again. But statistically, I would say most likely it will have to go through the B wave again, then go up to make another record high. So what should we do when this drop happens again? Well, let me present some stocks which could help us make some money while our other growth stocks are in the red. Here are some ETFs. First we have the ticker SQQQ, UVXY, TECF, SOXS, TZA, and FNGD. We will get into all of these, but as a friendly reminder, these ETFs are highly risky. Invest with caution. First, the SQQQ, 3 times the inverse, so negative 3x of the daily performance of the Nasdaq 100 index. It means that if you are shorting the Nasdaq 100 with 3 times the leverage, this is an extremely risky play. Currently, it's at $15. UVXY, ProShares Ultra VIX Short-Term Futures ETF, 1.5 times the performance of the S&P 500 VIX Short-Term Futures Index for a single day. If you buy this stock, I would strongly suggest you don't hold it for longer than 3 days. Direction Daily Technology Bear 3X Shares, TECS. The investment seeks daily investment results before fees and expenses of 300% of the inverse or the opposite of the daily performance of the Technology Select Sector Index. It means that you are shorting the tech companies with 3 times leverage. Extremely risky. Direction Daily Semiconductor Bear 3X Shares, SOXS. The investment seeks daily investment results before fees and expenses of 300% of the inverse of the daily performance of the Philadelphia Semiconductor Sector Index. It means that you are shorting the semiconductor companies with 3 times of leverage. Also extremely risky. Direction Daily Small Cap Bear 3X Shares, TZA. This ETF is shorting the daily performance of the Russell 2000 Index, the small cap companies with 3 times of leverage. I would say small cap companies will definitely benefit from the current administration in the long term, but currently it fluctuates a lot. Maybe we can play a bit here as you can see these peak cycles. Finally, we have the Microsectors FANG Plus Index, negative 3x Inverse Leverage ETN, FNGD. This ETF is shorting the daily performance of the big tech companies with 3 times leverage. The FANG Plus include Facebook, Apple, Amazon, Netflix, and Alphabet's Google. Plus another 5 actively traded technology growth stocks, Alibaba, Baidu, Nvidia, Tesla, and Twitter. I would not do it unless you are sure that this group of stocks are going down for sure. That's it for today's video. There are some recovery stocks that are doing really well, and I believe there are some that will be doing well in the next couple months. if we are having this correction again, now you know the ETF you can get into, which will short the market when you buy those ETF. But please be cautious. This is for entertainment purposes only. I'm just giving you these ETFs for your information only. You can day trade it, swing trade it, but definitely do not hold it for the long term. As always, don't forget to like and subscribe. Thanks for watching this video, and I'll see you guys in the next one.